Welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for that common sense approach to proactive planning with your money, your investments for your financial and retirement future. He is Chris McIntire, president and founder of McIntire Retirement Services. Always a pleasure to have you here on the program providing guidance, Chris. And this is the time of year. A lot of us have taxes on our mind. We talked about it in depth and had a great interview on last week's program. But you continue to bang the drum that right now is the time. It is the opportunity to change our paradigm, to shift our planning, and to manage those taxes.
Yes, it certainly is, buddy. And, we talked about it for years and years on the show. And, we always want to be active in having the tax conversation, no matter what's going on in the world today. And, being very proactive on the tax planning side is a lot better than being reactive. And what I mean by that is, okay, let's say they come out and they're going to raise interest rates in the year 2025. Well, we would be reactive to that, where right now we could be proactive in knowing that the Trump tax cuts of 2016 are going to expire in 2026. So, trying to be proactive in taking advantage of what we think are historically low income tax brackets to shift money from IRAs into Roth IRAs and to have them go from being forever taxed into never taxed dollars.
Yeah. Well, ladies and gentlemen, if you would like that proactive tax planning strategy session, if you would like the game plan for retirement, the written plan, bringing together income, investments, taxes, healthcare, and legacy, you can call Chris McIntire and McIntire Retirement Services now. No cost, no obligation for those discussions, for that planning review and that strategy session. A risk analysis of your current investments, get a better understanding on what you own, a tax analysis to show you what your future bill is likely to be, and then strategies to help you control that and make sure that your portfolio is in alignment with your timeline and goals. The number to call, again, no cost, no obligation, 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, when we enter into retirement, we have multiple sources of income, and they are different sources. We used to have the paycheck, right? That was our one source, and the government kind of taxed that before we even got to see our money. In retirement, we got pensions, we got retirement plans, we got Social Security, we got the personal savings and the retirement accounts. Is there a bit of a process of sort of figuring out the new tax situation we find ourselves in those first few years of retirement?
Yeah, certainly is. And, let's say we're dealing with some folks that are 65, they retired, they got on Medicare for their health insurance. And let's just say they both pulled their Social Security benefits as well. And then they're having to draw money out of their IRA account. And then we have to work on, okay, how much tax do we want to have withheld on those IRA distributions? Because many people, okay, do not have tax taken out of their Social Security benefit because not all of it is taxed anyway. So why tax 100% of it when only 85% of it might be taxed? That's kind of an analogy that a couple of our CPAs utilize. So, we have to, calculate what are we going to take out of the IRA accounts, and so let's say they're just taking monthly distributions. Okay. Pretty easy calculation. We take out this much for federal, this much for the state, and they may have to write in for their local taxes and whatnot, right? Not every company is going to withhold for your local taxes or something like that, or your school taxes. State and federal is very common. Okay? But then let's say they needed to buy a car. So they took out an extra $50,000 to buy a car from an IRA account. Okay, what is that tax impact? Did we go into the next tax bracket? Do we have to take out additional taxes so that they don't pay a penalty, or they don't have to come back and pay quarterly taxes next year? Very generic example that we deal with on a weekly basis, Peter.
Yeah, and Chris, it's not what we have, it's what we get to keep. It's what we get to spend out of those different streams of income. But right now, we've talked about we are in a historically low tax environment, and taxes still feel painful. Yes, we get it. But as we talked about last week in the interview with Becky Swansburg, she mentioned, I was sort of shocked by this, Chris, taxes would need to go up about 25 to 30% just to get back to kind of the historical average of where they have been. And when we enter into retirement as well, Chris, the first few years of retirement, we're probably in some of the lowest income and therefore the lowest tax years as it is anyway. Those are probably the years where we have less taxable income than ever before, and because of inflation and whatnot, probably ever again. And so that makes that window. Ed Slott has said it as well. It is the window of opportunity to do that proactive tax management.
Yes, absolutely. And here's an example. So the tax cuts we got in place from the previous president took the 15% tax bracket down to 12%. Okay. And that's on a fairly large amount of money there for Main Street Americans. And that was about $1,500 that put into everybody's pocket. So if you think of your $1 million IRA account, and if you're withholding 15% federal taxes and 4% or 5% state taxes, so let's just round it to 20%, that $1 million is worth $800,000 to spend, basically. If you're drawing it out on your monthly income, obviously a lump sum payout, it would be a lot more than that. So, when we say those tax cuts were targeted for the middle class, they really were. There was not the big upper echelon income tax brackets, despite what the media says. We did the numbers on the radio shows here and the figures on what was being saved on that 12% tax bracket over the 15%. So it's going back to the 15% bracket in 2026, as we said on many radio shows, and we will continue here. So, folks, you need to remember that when you walk in the ballot box, that they may say they're only going to target the rich. I'm telling you, everybody pays some degree of taxes that has an IRA account worth $500 to over $500,000, and you're pulling money out of it. There are tax ramifications for those withdrawals, and you need to be cognizant of, look, do I have any wiggle room in here to take additional funds and move them into a Roth IRA where it's going to be tax-free down the road?
Yeah. And Chris, the qualification, are you rich? Do you have money, investments, assets saved, right? Is basically the criteria to say, are you rich? Are you wealthy these days? Is, do you have any assets, so to speak?
Yeah, it. If you have assets, and again, there are, what is there, $13 trillion in taxable IRA accounts right now. Well, they know where this money's at, and how to create additional revenue would be changing required minimum distribution guidelines. And if you think of it, they already did. So required minimum distributions used to be at age 70 and a half. Now they're at age 73. Well, guess what happens to an investment account over time? It grows. So what happens to those required minimum distributions from somebody at age 73? In 3 years, they didn't have to take anything out. That's a greater dollar amount. Okay. Now, when those people pass away and they leave the money to their children have to pay those IRA outs within 10 years, not over the rest of their lifetime. So they have made some, I'll call them subtle changes, but for you and I, some of these were pretty, big game-changing legislative moves that they have made to, force distributions, if you will.
Yeah. And they were not short-sighted in some of that thinking. If growth is the goal for you with your money on your retirement and particularly tax-deferred accounts, well, the IRS shares that goal with you. They know that means they get to harvest more dollars down the road. So when is the better time to manage that and to mitigate that tax liability? Well, right now is a good time, ladies and gentlemen. We are in an optimal tax environment to do so. And Chris McIntire can help you through that process and show you the numbers. It is not something that is inherently difficult to do, but it is something that you don't want to mess up on and cost yourself unnecessarily. So Chris McIntire will help you make sure that all of the numbers add up, that you are paying only what you need to, your legal, moral, ethical, minimum required tax bill, and then no more. And then that you get to keep more of your money. You get to spend more of your money. You get to leave more of your money behind for your beneficiaries, for your spouse, for your children, for your loved ones, your churches, your charities, your causes and organizations. That is ultimately the goal of effective tax planning and what is achieved when it is done correctly. So give a call, pick up the phone, talk to Chris McIntire, 800-868-1194. That's 800-868-1194. And Chris, I mentioned that the first couple years of retirement is figuring it out, but we are generally in a lower taxable income. So that could be a window of opportunity. However, there's another key benchmark in age, a milestone that gives us greater flexibility and opportunity to manage taxes. And that is if we have reached, achieved, or passed the age of 59 and a half. And I think a lot of people know that, oh, this is when I can start drawing from my IRAs or 401ks without the additional 10% penalty. But 59 and a half actually opens some additional doors and windows that aren't as well known, I think.
Yeah, correct, Peter. So let's say we've got somebody that's been working at the Whirlpool Corporation in Clyde, Ohio for 25 years, and they're 59 and a half now. And they may want to work for another 5 or 6, 7 years or so. Maybe they're going to go to Medicare at 65, for example. Okay? But at 59 and a half, they have access to a portion of their 401k accounts that they could roll over into IRA accounts. They could pick a number of different investment vehicles that certainly aren't available inside their 401k accounts. But once they're outside in the IRA side of things, then it's a little easier to manage the tax distributions, the Roth IRA conversions and whatnot, because a distribution from a 401k is a mandatory 20% federal tax withholding, and that's not even the state of Ohio. So if we're doing Roth IRA conversions, we're typically maxing out at 12, okay, the 12% bracket. Why would we want to pay 20 on just a distribution? So that's an area that we help a lot of folks on, is once they achieve that age of 59 and a half, to do some tax planning, pre-retirement planning, begin putting that income plan together. A number of different things can happen there. Okay. But let's address somebody who had worked at a place for maybe 15, 20 years, and they got $100,000 in an old 401k. They got into a new job and they're in their new plan, right? We help a lot of people close out those old plans. So, even if you're not 59 and a half, you can close out those old plans, roll them into an IRA account as well. So a number of different pieces of flexibility, pre 59 and a half and then post 59 and a half.
Yeah, a lot of different times and opportunities. And Chris, we may overlook those opportunities to save, to keep more of our money, to build for a more secure financial future if we are not in regular conversations with a proactive planning advisor, an experienced qualified advisor like yourself, going to be able to spot and identify where we've got some of those opportunities to take more control of our financial outcome. But most of us have our head down, our nose to the grind. Yes, we're doing a good job of putting some money away, saving as part of our habit and routine, but we might not otherwise identify some of those critical opportunities. I think that's a big part of the job, the service, and the help and assistance that you provide your clients.
Yeah, without question. We do a lot of different things. We help them with, the tax planning, the investment planning, the income planning, obviously, estate planning services that we can utilize through our strategic partnerships, help them with their health insurance as well. And, let's just be honest, as time goes on, we have spouses that pass away, and, we help the widows transition and, into the next stage of life. And I say that with, my aging parents and whatnot, that, as someone who's going to be 59, the amount of time and effort it takes to start taking care of aging parents is something that we have to figure in there as well, because the time value of money and also the value of time also is of significance. We deal a lot with helping people and coaching them through that and finding resources for them.
Well, again, if you would like a resource, ladies and gentlemen, that is what you have with Chris McIntire. Offices conveniently located across Northwestern Ohio, nearby, close to you, convenient. But of course, if you'd like to begin the conversation wherever you are through the ease and convenience of technology, or even just a phone call, that is also certainly available for you. All you got to do to start the conversation is pick up that phone, give a call, 800-868-1194. That is 800-868-1194, 800-868-1194. 800-868-1194 to reach Chris McIntire, McIntire Retirement Services. You can also go online, McIntireRetirementServices.com. And again, no Y's there. It's all I's. McIntireRetirementServices.com is a great resource. The library of podcasts on any number of different topics, important financial conversations that would pertain to almost any situation you could find yourself in. You can find the specific episode that might apply on the library at McIntireRetirementServices.com, or even on YouTube. The library available there as well. You can subscribe to get the weekly podcast sent right to your inbox and be notified of that. We encourage you to do that as well. So McIntireRetirementServices.com, that's where you can find Chris and the team online anywhere, or get the conversation started. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194. And Chris, as we are kind of nearing the end of wrapping up and getting close to the tax filing deadline for last year, a lot of people probably have their tax checklist, but what we might overlook on the tax checklist is let's also reflect and plan ahead for next year and all of the years to come. And that's a big part of the process where taxes and investments really correspond and need to be more complementary than what we often find. Kind of the separation of church and state, it seems like, is often the case between taxes and the financial and investment management. They really should be much, much more coordinated.
Well, sure, Peter. And, now today we have, for people that have non-IRA investments like CDs, money market accounts, that are paying a much higher yield. I believe I saw where there's like $6 to $8 trillion in money market accounts. And it's one of the biggest holdings we have for our clients, and it's yielding about 5%. So, if you had $100,000 in a money market account and you made 5% on that, outside of your IRA account, that's an additional $5,000 of income. So I think a lot of people are going to be shocked when they start seeing their tax returns and figuring out what they owe, or the refunds that they may or may not be getting might be different because, hey, you're making money on idle dollars that we hadn't for many years. So I think we all need to be prepared for that, myself included, with, some dollars parked in a money market account. So, we've been focusing here, on income taxes, Peter, but, we also deal with the capital gains taxes, which would deal with, typically your non-IRA investments. You bought NVIDIA stock and then, ended up selling it after it tripled in value, and you may have to pay a significant capital gains on that. And, for most people listening to the show today, their capital gains taxes are going to be between 0 and 15%. They can go up to 20% for high income earners as well. But for most folks here, we're looking at 0 to 15%. So what do you mean zero? How do you pay a 0% capital gains tax? Okay. The rate of your capital gains taxes are tied into your income tax rate. So depending on what income tax bracket you're in, that determines what your capital gains rate is. A progressive tax system, right? The more money you make, the more taxes that they get. That's full of potholes or things that you can step in. So if your income tax bracket is 12%, your capital gains tax rate is 0 until you get into the 22% income tax bracket. Then the capital gains rate becomes 15%. So, we always focus on income taxes. The capital gains piece is pretty important as well when you're in a bull market, to make sure that you sell some capital losses to offset capital gains. That's just as important as Roth conversions as well for people that have money outside retirement accounts. And forgive my long-winded diatribe there, buddy.
No, I think it's very important, Chris, because the tax code is complicated. There's lots of different pieces and moving parts. I mean, it's more than 70,000 pages of tax law code, as I understand it. I have not personally read it all, but I do some heavy reading, not quite that heavy. However, there are different elements, there are different aspects, there are different types of taxation, and that tax that you're talking about there, the capital gains, that's not on retirement accounts, right? The retirement accounts, the IRAs, the 401ks, the Roths, those have different tax qualifications completely. But the capital gains, that's on just money that we've earned and decided we didn't need to spend. We wanted to do something with it. So we invested it. And then we get taxed again on the growth. And there is a difference as well between how long we held that investment, right? Long-term versus short-term capital gains are treated differently as well.
Yeah, no question about it. And, that's why, you don't want to be day trading outside of your IRA account because you're spinning off too many short-term capital gains, most likely. So, having the wherewithal, the knowledge of knowing where to act and now to what accounts do you react that quickly in, which, we could probably talk about stop losses, for example. And, we've got a number of clients talk about stop losses and, so a stop loss is where you would put a mechanism in place where if your stock fell, for example, and let's say your stop loss percentage was 15%. So if the investment you had fell by more than 15%, it would sell. Okay. But that sell might also create a capital gain. So, you sold it plus lost 15% of the value for protecting it. Right, it fell 15%. You sold it and paid a 15% capital gain on what you had. So, you have to take all that into the equation on, is that are those the right strategies? Yeah, and not saying they're right or wrong by any stretch, just pointing things out here today.
Course, I do have personally a little play trading account that I dabble in, and it isn't a Roth because I understand that otherwise every transaction could be a taxable event. So I have it placed inside of a partial portion of my Roth assets where I do that trading. I have wondered about stop losses because I know that they are a mechanism that can prevent precipitous losses with a particular holding. But I also understand that some of the best days in the market and in a stock or in a position sometimes happen. The best days happen right after some of the worst days. So could a stop loss also have kind of another side of the coin, so to speak, there, in that it is a stop gain as well?
That's a great analogy, and that's what I bring up as well to folks is, that, very often the market has the best days after it has some of its worst days. And if you miss those best days, you really are losing your compounded rate of return average over a market cycle. And I suppose if somebody's, buying some really speculative type of stocks, you could probably make a better argument for having some of those stop losses. But if you're buying, some of the bigger bellwethers that have been around for a long time and your goal is to hold them for a long time, then, I would caution against some of the use of stop losses on that because, they're good for 6 months and then you got to go back in and have them, put back on. And, what if you're reinvesting dividends and, all of those things that can come into play, or you make additional purchases, where's the stop losses and all that. So it can be, there can be a fair amount of administration to it as well.
Well, once again, Chris, I think that myself and many of the average folks out there, nose to the grind, blinders on, just working day to day, and maybe don't pay as much attention to the finances and the investments. Once we've saved the money, we've done our part of the job, right? I think that understanding all of those things that then must go on and happen behind the scenes with those investments, that's where the true benefit is of working with a trusted, experienced, qualified professional such as yourself, is that you're paying attention, you know where those opportunities are, you know where the pitfalls can potentially pop up, and you can help people navigate to an optimal financial future.
Sure. And we help, clients of a certain size, we actually pay to have their income tax returns done as well. So, that helps us keep proactively involved. We have a relationship with the CPA. So, we can reach out to them and, toward the end of the year is when we do more Roth IRA conversions and we can assist then.
Chris, how often do you see somebody when they're doing their returns hit the nail right on the head and have paid exactly what they end up owing versus how much more likely is it that we get a refund or owe a little check? And which one's more favorable? Multi-part question there.
Well, I would, as somebody who's been self-employed, we always end up owing more, it seems like, or if we do overpay, they just keep it. And we apply it to the next quarter's tax piece. So I suppose, it's probably better to get a little bit back versus owe a little bit. But yeah, not to hit the nail on the head, I couldn't tell you of anybody I know that has done that. But maybe we'll hear something this year as we pay for more and more returns.
That's like, I mean, we're March Madness season here, right? That's like picking the entire bracket exactly right, scores and all.
Yeah, there you go. Yeah, exactly.
Well, again, we are talking with Chris McIntire, McIntire Retirement Services, Northwestern Ohio, your resource for proactive guidance, experienced, qualified, professional guidance on your money, your investments, your taxes, healthcare, legacy planning. If you would like to get the game plan for retirement, the physical written document, the plan that outlines where you are currently, your goals, and your path forward with your money to achieve them, pick up the phone and give a call. No cost, no obligation. This is a complimentary service that Chris McIntire and the team from McIntire Retirement Services offer to listeners to the program. So all you need to do, your part, pick up the phone, get that conversation started. 800-868-1194. That's 800-868-1194. 800-868-1194. Or you can go online, McIntyreRetirementServices.com. McIntyreRetirementServices.com. And Chris, depending on where we are, but in the range, that 55 to 65, certainly 59 and a half plus, that is the window of opportunity. And when you've crunched the numbers for individuals within kind of that window and shown them, here's your current balance, here's the IRS's plan, should you continue to defer, default, kind of not manage the taxes now, it really is astounding. I mean, eye-opening when you look at on the other hand, here's what we could reduce that bill down to if we are proactive, oftentimes a 40, 50, 60% tax savings or more.
And it's, what's unique about this, Peter, is, most of us think that, all right, let's pick some good investment strategies in my IRA and we'll be fine as we go through life. And then we incorporate a Roth IRA conversion strategy and it starts to even look better. And then you throw in, look at the option of what does cash value life insurance do versus a Roth conversion. And, we had our friend from Stonewood Financial on here recently. And, in a lot of cases, it's not even close, Yeah. And when you show that to folks, they're like, why have I never heard of this before? It's like, well, it takes a lot of work. It's a heck of a lot easier just to do a IRA rollover and get and get paid on managing those assets versus not, I don't want to say complicated, a more complex system of using Roth conversions through, Roth IRA investments, and then, some of the life insurance policies that are available today that, hey, may even have long-term care written in there, tax-free death benefit, tax-free cash distributions that don't show up on a tax return. I mean, a lot of things you can do with life insurance other than just passing away and paying someone a benefit. But the industry needs to do a better job of promoting itself without a doubt.
Yeah, and there's some pitfalls there as well that you try to help people get the benefit of, but avoid those pitfalls. And that's part of proactive planning, ladies and gentlemen, is that you evaluate your goals and then you evaluate all of the tools that are available to find what is appropriate and what is the best, most efficient way to achieve and accomplish your goals. And if your goal is growth on your money, if your goal is to keep as much of it as possible, again, we are talking about the opportunity for tax management. Being efficient with your taxes is probably as effective as shooting for higher returns on your investment. However, it carries with it oftentimes far less risk. So let's be as effective as possible. Let's minimize the risks where available. Tax planning, proactive tax planning is where that sweet spot is. And Chris McIntire helps his clients with that each and every day. Pick up the phone, give him a call for that complimentary review to have these conversations, to crunch your numbers and to get your game plan for retirement. 800-868-1194. That's 800-868-1194. 800-868-1194. Chris, as always, it is a pleasure having you here on the program, joining us each and every week, being the resource, the guide for so many across Northwestern Ohio to have a more optimal plan for moving forward, making progress in their financial future.
Yeah, I appreciate it, Peter. And a quick analogy is, if you were going to have somebody come over and remodel your house, Would you like him to show up in a car and he gets out with a hammer? Or would you like him to show up with a truck loaded with tools and a crew? And that's what we would like to do.
Yep. All the tools there, ladies and gentlemen, available to you and helping you determine where and when each is appropriate. That is what Chris McIntire does for his clients. So many have taken advantage of the opportunity for the complimentary review and to get that game plan for retirement. So many more need to. So pick up the phone if you have not yet. Give McIntire Retirement Services and Chris McIntire a call. 800-868-1194, 800-868-1194, or online at McIntireRetirementServices.com. Chris, once again, always a pleasure. Thank you for being here.
Hey, my pleasure, Peter. Thanks, everybody. Be careful out there. Stay safe.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.